Looking at the oil market, moving lower right now, just a fractional decline. What do you think that says about oil investors and their view of this capture of Maduro and the U.S. plan, at least the initial plan, to quote unquote run the country?
Well, I think you said it. I mean, the oil market is clearly oversupplied. There isn't a lot of concern about supply in the market. And even, I mean, with the events over the weekend, that did not hit supply in a way to panic traders. And we've been seeing this behavior for a while now, that geopolitical risk is being kind of set aside. And there's an underestimation of geopolitical risk and its impact on supply, partly because it's offset by these headlines that there's a massive glut in the market, which I personally disagree with that statement. But there
Really?
is a state of oversupply, which is preventing oil prices from going up. And we expected this reaction when markets open today.
All right. I mean, this is very interesting. So you disagree with the idea that there's a massive oversupply. That seems to be consensus. I want to talk to you about more specifically about what's in Venezuela, that heavy crude. Friend of the show, Ben Emmons from FedWatch, he came out with a note saying that heavy crude is more profitable. That's about 2/3 of the reserves there in Venezuela. And he listed a number of companies that he believes that would benefit from that. He says Valero, Marathon, and Citgo, they're optimized for heavy crude, and they would find these reserves to be very attractive. Do you agree with that statement? And also the fact that we're seeing oil prices move, oil majors move higher. What does that say about, again, the investor sentiment when it comes to this operation?
Sure. I mean, this is a reaction, again, a knee-jerk reaction to what happened and what President Trump said about U.S. companies potentially going into Venezuela. And I do agree with the statement that heavy crude is an asset and is profitable, but it's about getting that heavy crude out of the ground. Reserves are something different than actual production. It's true that Venezuela has the highest reserves in the world, but its production is not the highest in the world. You have other countries like Russia, like Saudi Arabia, and their production is much higher. And that's because there's been a constant investment in the upstream sector. When it comes to Venezuela, they've neglected the upstream sector for a long time. They've been impacted by sanctions, corruption, you name it. So it's going to be really difficult for any of these companies to just go in, open a tap, and instantly get those reserves out of the ground. It's going to take 5 to 10 years, maybe, and a lot of capex. And when it comes to these, especially the IOCs, or you're looking at American companies, the return on investment is the key priority for any of them. So just kind of understanding how profitable it is going to be the key priority before jumping into a situation and exposing themselves to an unknown market and an unknown political situation, which is far from being resolved.
All right, you're bringing up ROI. That's obviously very important. By the way, we're looking at Chevron and some other names moving higher. Chevron often seen as the best position because they're right there on the ground there in Venezuela. Let's talk about this. Getting that oil out of the ground in Venezuela, I've seen some estimates say it's going to take about $20 billion in CapEx. How much money do you think it's going to take? And then how does that compare to the attractiveness of the Middle East or even the Permian Basin here in the U.S.?
Yeah, $20 billion, but you need $20 billion for 5 to 10 years. So we're talking about $100 billion of constant investment to have a huge increase in the country's capacity. I mean, what we're seeing from Kepler's data currently, that they're having to decrease their production, and their exports are also being impacted. So the immediate impact on the market is it's quite different. I think that might be even like tightening the market a bit, because we're losing some of that supply. So in terms of investment, I think these companies need to be prepared to do that for a number of years, and not just 1 year of investments. And how does that compare to other crude? I mean, if you look at the Middle East, for example, Saudi Arabia or the UAE, Kuwait, and so on, I mean, the cost of production is maybe $3 to $5. So there is a really big gap. And for Venezuela, I believe maybe it's closer to $15 to lift a barrel there.
Yeah, we just had our Michelle MCC just kind of say it was in that range of somewhere around $15 a barrel to kind of produce. I want to go back to something you just said. You said taking this production offline is tightening the market. So the estimates are, give or take, about 100,000 that Venezuela's been producing about 1 million barrels per day. Some people say 900,000, other people say 1.1 million. But you're saying it's tightening the market, and you're also giving a bit of a contrarian view that there's not an oversupply on the market. So can we just bottom line this? What does this operation mean? The long-term potential, but also in the near term when it comes to global supply?
Sure. I didn't say that there isn't an oversupply in the market.
Okay.
The market is oversupplied, and there is a buildup of supply in Q1, and this normally happens during this time of the year. I was arguing of the statement over there is a massive glut in the market. A glut is just too big of a
Okay.
word here,
Understood.
especially if we're seeing demand this year. I mean, by our own estimates at Kepler, we're seeing demand grow by 1.3 million barrels a day. OPEC's numbers are closer to 1.4 million barrels a day. So we're going to start assessing how the market's going to shape up maybe by the second or third quarter when that demand
Understood.
kicks in. And with the OPEC Plus group, I mean, their intention really is to just wait. As you saw the agreement that they took yesterday, they plan to pause any increments in Q1 to avoid adding more supply to the market, and then assess the situation and return back to unwinding the voluntary cuts.
All right. I mean, one last quick question. What does this mean, again, for the global supply, specifically for China that gets a lot of this Venezuelan oil and other countries that actually do import the oil despite some of the restrictions from the U.S.?
Yeah, they will basically have to turn to other barrels. I mean, we've been seeing China seize its purchases from Venezuela for a while now. It's becoming more difficult, and it's going to put other heavier barrels in the market at an advantage. And this is where China is going to be going to. And overall, I mean, we're still going to see a very mild to no reaction to any kind of geopolitical risk that doesn't directly impact supply, because again, the market feels that this market is very well supplied.